The economic and social consequences of money laundering. Money laundering is a result of any crime that generates profit for the criminals involved. It knows no boundaries, and jurisdictions in which there are weak, ineffective, or inadequate anti-money laundering (AML and CFT legislations and regulations are most vulnerable. However, large well-developed financial centers are also vulnerable to laundering due to large volumes of transactions that allow the launderer to blend in, as well as the wide range of services that enable the launderer to conduct transactions in a way that is convenient. Because most launderers want to eventually use the proceeds of their crime, their ultimate intent is to move funds through stable financial system. Money laundering has significant negative economic and social consequences, especially for developing countries and emerging markets. The easy passage of funds from one organization to another, or relatively facile system that allow money to be placed without raising any questions, is fertile territory for money launderers. The upholding of legal, professional, and ethical standards is critical to integrity of financial markets. The potential macroeconomic consequences of unchecked money laundering includes increased exposure to organized crime and corruption, undermining the legitimate private sector, weakening financial organizations, dampening effect on foreign investments, loss of control of or mistakes in decisions regarding economic policy, economic distortions, and instability. Loss of tax revenue, risk to privatizations affects reputations risk for the country, risk of international sanctions, social costs, reputational risk, operational risk, legal risk, concentration risk. Next topic is increased exposure to organized crime and corruptions. Successful money laundering enhances the profitable aspect of criminal activity. When a country is seen as haven for money laundering, this can attract people who commit crimes. Typically, haven for money laundering and terrorist financing have limited number of predicate crimes for money launderings. Such criminal offences that would permit a jurisdiction to bring a money laundering charge. Limited type of organizations and persons covered by money laundering law and regulation. Little to no enforcement of the laws and weak penalties of or provisions that make it difficult to confiscate and freeze assets related to money laundering. Limited regulatory capacity to effectively monitor and supervise compliance with money laundering and terrorist financing laws and regulation. If money laundering is prevalent, there is more likely to be corruptions. Typically, the penetrations of organized crime groups in a jurisdiction is directly linked to public and private sector corruption. Criminals might try to bribe government officials, lawyers, and employees of financial and non-financial organizations so they can continue to run their criminal businesses. In countries with weaker laws and enforcement, it is often corruption that trigger money laundering. It also leads to increase in the use of bribery in financial organizations. Among lawyers and accountants in the legislature, in enforcement agency, with police and supervisory authorities, and even with court and prosecutors. A comprehensive AML-CFT framework, on the other hand, helps curb criminal activities, eliminates profits from such activities, and discourage criminals from operating in a country, especially where law is fully enforced and the proceeds from crime are confiscated. Undermining the legitimate private sector. One of the most serious macroeconomic effects of money laundering is felt in the private sector. Money launderers are known to use front companies, that is, businesses that appear legitimate and engage in legitimate businesses, but are in fact controlled by criminals who commingle the proceeds of illicit activity with legitimate funds to hide the unlawful gains. These front companies have a competitive advantage of legitimate firms because they have access to substantial illicit funds, allowing them to subsidize products and services sold at below market rates. This makes it difficult for legitimate businesses to compete against front companies. Clearly, the management principle of these criminal enterprises are not consistent with traditional free market principle, which result in further negative macroeconomic effect. By using front companies, particularly multiple front companies and other investment in legitimate companies, money laundering proceeds can be used to control whole industry and sector of the economy of certain country. This increases the potential for monetary and economic instability due to the misallocations of resources from artificial distortions in asset and commodity prices. It also provides a vehicle for evading taxes, thus depriving the country of revenue. Weakening financial organization. Money laundering and terrorist financing can harm the soundness of a country's financial sector. They can negatively affect the stability of individual banks and other financial organizations, such as security firms and insurance companies. Criminal activity has been associated with several bank failures around the globe, including the closure of the first Internet Bank, European Union Bank, and Greek banks. The establishment and maintenance of an effective AMS CFT program is usually part of a financial organization's charter to operate. Non-compliance can result not only in significant civil money penalties but also in the loss of its charter. Dampening effect on foreign investment. Although developing economies cannot afford to be overly selective about the sources of capitals they attract, there is a dampening effect on foreign direct investment when a country's commercial and financial sector are perceived to be compromised and subject to the influence of organized crime. To maintain a business-friendly environment, these impedances need to be eliminated. Loss of control of or mistakes in decision regarding economic policy. Due to the significant amount of money involved in the money laundering process, in some emerging market countries, these illicit proceeds might dwarf government's budget. This can result in the loss of control of economic policy by governments or in policy mistakes due to measurement errors in macroeconomic statistics. Money laundering can adversely affect currencies and interest rates as launderers reinvest funds where their schemes are less likely to be detected, rather than where rates of return are higher. Volatility in exchange and interest rates due to unanticipated cross-border transfer of funds can also occur. To the extent that money demand appears to shift from one country to another because of money laundering resulting in misleading monetary data, it can have adverse consequences for interest and exchange rate volatility. This is particularly true in economics based on the US dollar, as the tracking of monetary aggregates becomes more uncertain. Last, money laundering can increase the threat of monetary instability due to misallocation of resources from artificial distortions in asset and commodity prices. Economic distortions and instability. Money launderers are not primarily interested in profit generation from their investment, but rather in protecting their proceeds and hiding the illegal origin of the fund. Thus, they invest their money in activities that are not necessarily economically beneficial to the country where the funds are located. Furthermore, when money laundering and financial crime are redirect funds from sound investment to low quality investment that hide their origin, economic growth can suffer. Loss of tax revenue. Of the many underlying forms of illegal activities, tax evasion is perhaps the one with the most obvious macroeconomic impact. Money laundering diminishes government tax revenue and therefore indirectly harm honest taxpayer. It also makes government tax collection more difficult. This loss of revenue generally means higher tax rates that would normally be the case. A government revenue deficit is at the center of the economic difficulties in many countries, and correcting it is the primary focus of most economic stabilization programs. The International Monetary Fund (IMF) has been involved in efforts to improve the tax collection capabilities of its member countries. And the Organization for Economic Cooperation and Development (OECD) has been instrumental in moving many jurisdictions toward tax transparency. Risk to privatization effort. Money laundering threatens the efforts of many states trying to introduce reform into their economy through the privatization of state-owned properties, such as land, resources, and enterprises, sometimes linked with corruption or inside deals. A government might award a state privatization tender to a criminal organization, potentially at an economic loss to the public. Moreover, while privatization initiatives are often economically beneficial, they can also serve as a vehicle to launder funds. In the past, criminals have been able to purchase ports, resorts, casinos, and other state property to hide their illicit proceeds and facilitate their criminal activities. Reputation risk for the country. A reputation as a money laundering or terrorist financing haven can harm development and economic growth in a country. It diminishes legitimate global opportunities because foreign financial organizations find that the extra scrutiny involved in the working with organizations in money laundering haven is too expensive. Legitimate businesses located in money laundering haven can also suffer from reduced access to markets or might have to pay more to have access due to the extra scrutiny of ownership and control system. Once a country's financial reputation is damaged, rebuilding it is very difficult. It requires significant resources to rectify a problem that could have been prevented with proper AML controls. Other effects include specific countermeasures that can be taken by international organizations and other countries and reduce eligibility for governmental assistance. Risk of international sanction. In order to protect the financial system from money laundering and terrorist financing, the United States, United Nations, European Union, and other governing bodies may impose sanctions against foreign countries, entities, individuals, terrorists, and terrorist groups, drug traffickers, and other security threats. In the United States, the Office of Foreign Asset Control, or FAC, of the U.S. Department of the Treasury administers and enforces economic and trade sanctions. Countries can be subject to comprehensive or targeted sanctions Comprehensive sanctions prohibits virtually all transactions with specific country. Targeted sanction prohibits transaction with specific industry, entity or individuals listed on OFAC's Special Designated National and Block Person SDN list. Failure to comply can result in criminal and civil penalties. FATF also maintains a list of jurisdictions identified as high risk and non cooperative where AML CFT regimes have strategic deficiencies and do not meet international standards. As a result, FATF call on its members to implement countermeasures against these jurisdictions, such as financial organizations applying enhanced due diligence (EDD) to business relationship and transaction with natural and legal person from an identified jurisdiction in an attempt to persuade it to improve its AML